Hey guys, it's Johnny, your Orange County real estate agent, and today we're digging into the fall market and why this season feels like deja vu from 2024 and why it's also different. So let's rewind to last year. In 2024, mortgage rates peaked around 7.5% several times by April. From there, they drifted lower through the summer and finally broke below 6.5% at the end of August, touching roughly around 6.1% in September. That sub 6.5% window lasted 47 days and it wasn't even that long, but it was long enough to lift demand. We saw it clearly in pending sales across Southern California. And what happened was that they mirrored most of the markets we track in the Bay Area, Phoenix, Las Vegas, and even the national pattern. But then that came October. Strong labor reports and resilient economic data pushed yields higher and mortgage rates pushed back up to around 7% through the end of the year. That quick retreat above 7 dampened momentum and made early 2024-25 feel sluggish. Now let's talk about where we are today and why this fall is both familiar and different. Demand this year is starting from a higher baseline than last year and the year before. The reason is straightforward. We're back below 6.5%. And this time, it looks like we may stay there even longer. When rates hold under that threshold with some duration, buyers respond, pending sales rise, and showings pick up even more, and that filters through better absorption. On the supply side, we finally see a normal seasonal peak again. In Southern California, inventory topped out in mid-July, closer to the pre-pandemic pattern, then started easing through late summer. The last couple of years peaked later because higher fall rates slowed absorption and let inventory keep building. This year's earlier peak patterns, if inventory is gently trending down while demand is gently trending up, the market's velocity improves. You feel that as fewer stale listings, fewer dramatic price cuts, and a healthier cadence of new escrows. So let's put speed into a single metric. Expected market time, the number of days it would take to sell the current active inventory at most recent pace of pending sales. It's a far better read than average days on market. Though much of 2024 expected market time was elevated and then flattened in the fall as rates rose. This year it's began to ease earlier. If rates remain near below roughly 6.25, we should see expected market time stabilize or improve into the fourth quarter. So now here's why 2025 isn't a carbon copy of 2024, the spread. I'm talking about the historical relationship between the 10-year treasury yield and the 30-year mortgage rates. Over the long run, mortgage rates tend to track the 10-year plus a spread, about 1.75% points on average. During the pandemic and the subsequent rate hiking cycle, that spread blew way out well above normal as lenders price in uncertainty and prepayment risk. Over the last year, that spread has been steadily compressing towards normal. Translation, even if the 10-year hasn't fallen dramatically, mortgage rates can still drift lower because the risk premium is easing. To make it concrete, when we recorded in June, mortgage rates around 6.3% would have been closer to 6.5% a year earlier at the same 10-year yield because last year's spread was wider. Go back to the peak spread in mid-2023 and that same yield would have implied something like 7.3%. The spread improvement makes it much more harder for rates to lurch back above 7% unless the underlying economy reaccelerates in a meaningful way. And that's a key difference from last fall. So what does this mean for the rest of the year? If we hold below 6.5%, and especially if we flirt with or dip under 6.25, pending sales should continue to firm up. And inventory should follow its typical fall path lower. Together, that points to a modestly faster market into the holidays than we saw last year. It also sets up a better starting point in the early 2026, a market that ends with the year with lower inventory and higher absorption, tends to enter January with more energy, and more serious buyers in the pipeline, fewer stale listings, and sellers who price with the market instead of last spring's headlines. A few practical takeaways for this video. If you're a buyer, this is a more navigable market than a year ago. Rates under 6.5 open doors, but they don't create a frenzy. You can negotiate and you can be selective. Just know that well-priced, move-in ready homes still move quickly. And if you're a seller in today's market, pre-listing preparation and pricing discipline matters a lot. The market is better than last fall because of rates, and it's still price sensitive. Launch clean, launch ready, and launch at the market, and don't aim for the outlier and then chase. If you're watching the rates right now, watch both the 10-year yield and the spread. A gentle downtrend in the 10-year plus continued spread normalization is a powerful tailwind for housing without the whiplash of a sudden rate crash. To wrap up for this video, yes, this fall echoes 2024. In some ways, rates eased, demand responded, but the crucial difference is spread compression, and that makes a repeat spike back above 7% less likely and supports steadier demand into the year end. If that holds, 2026 starts on stronger footing with rates below 6.5 for longer and a healthier balance between supply and demand. If you guys found this video super helpful, give this a like and give the video a like and subscribe for more weekly market clarity, and drop your questions in the comments down below. And for deeper local data across SoCal, I'm your Orange County real estate agent. If you guys do like this video, drop that like below, and thanks for watching, and I'll see you in the next housing video.